If you're a freelancer sitting on a good year right now, waiting until April to decide where the money goes, that decision is already costing you. Not in some vague someday sense, in real dollars. The 401k employee deferral limit for 2026 is $24,500 per IRS notice 2567, and the total that can go into a solo 401k between your employee and employer sides is $72,000. If you don't have that plan open and funded, you're not deferring a smaller amount. You're deferring zero on the employee side. And here's what stings. Vanguard's How America Saves report puts the average participant deferral rate at 7.7% of pay, which for a freelancer clearing $120,000 works out to about $9,240 a year? Money that could have grown tax deferred for 30 years. Gone because a form didn't get signed by December 31st. So what actually changes between 2026 and 2027? And which of those numbers do you need to lock in before the calendar flips? Let's set the table properly, because half the confusion out there comes from people quoting the wrong year's numbers at each other in Reddit threads. For 2026, the IRS confirmed these in Notice 2567, employee deferral into a 401k, including a solo 401k, $24,500. Catch up if you're 50 or older, $8,000 on top. If you happen to be 60, 61, 62, or 63, there's a bigger super catch-up of $11,250 instead. That's the Secure 2.0 provision that a lot of people still don't know exists. IRA limit is $7,500 with a $1,100 catch-up at 50 and up. HSA is $4,400 for self-only coverage, $8,750 for a family, plus $1,000 more if you're 55 or older. And the overall defined contribution ceiling, the 415C limit, the one that caps everything going into your solo 401k from both hats you wear, is $72,000. Write those down. Those are your 2026 numbers, and they're the ones you're operating in right now. Now, 2027. I'm going to be straight with you instead of pretending I have a crystal ball, because a lot of channels are going to publish confident-sounding 2027 tables and just make them up. The IRS sets these limits through an annual cost of living adjustment under Section 415D, and the announcement typically lands in the fall. That's the notice that will actually govern 2027. Until that notice exists, nobody has verified 2027 figures. What I can tell you is exactly how the machine works, so when the number drops, you'll already know whether it changes your plan. The adjustments are indexed to inflation and then rounded down to set increments. The 401k deferral limit moves in $500 steps. The IRA limit moves in $500 steps. The 415C total moves in $1,000 steps. HSA limits move in $50 steps and get announced separately, usually in the spring, well before the retirement numbers. So the practical question isn't what's the 2027 number? It's, does the inflation reading push us over the next $500 threshold or not? Some years it does. Some years the deferral limit sits flat 2 years in a row because the index didn't clear the rounding hurdle. That's not the IRS being cruel, that's just how the rounding rule works. Your personal situation changes which of these even matters, by the way. If your net self-employment income is $48,000, the 415C ceiling of $72,000 is theoretical. You'll never touch it. If you cleared $200,000 on 1099s last year, that ceiling is the entire game. So here's the stance I'll plant a flag on. Stop waiting for 2027 numbers to make 2026 decisions. That's the trap. Every January I watch freelancers freeze because they want the new figures before they open an account. And by the time the figures land, they've burned another year of employee deferrals they can never get back. The employee deferral is use it or lose it by plan year. The employer side has more grace, and I'll get to that, but the deferral does not wait for you. Let me talk about the solo 401k specifically, because this is the single most expensive mistake I see, and I say that as someone who made it personally. I filed 3 self-employed years using nothing but a SEP-IRA because it was easy to open in 10 minutes online, and I thought easy equaled optimal. It doesn't. Here's the math that woke me up. A SEP-IRA lets you contribute roughly 20% of your net self-employment income after the self-employment tax deduction. Solo 401k lets you do that same employer piece and stack the full employee deferral on top. Take a freelancer with $80,000 of net self-employment income. The SEP side gets you somewhere in the neighborhood of $16,000. The solo 401k gets you that same employer piece plus up to $24,500 of employee deferral, call it around $40,000 of tax-deferred room instead of $16,000. Same income, same person. One extra form filed before December 31st. At a combined federal and self-employment marginal rate in the low 30s, that extra $24,500 of deferral is roughly $7,000 to $8,000 staying in your pocket this year. Not compounded, not projected. This year's tax bill. Your filing status and bracket move that number, obviously. Married filing jointly with a spouse pulling a W-2 salary and health insurance puts you in a completely different place than a single filer at $60,000. But the direction of the answer doesn't change. The solo 401k wins on room, and it wins by a lot. Now the deadline nuance, because this is where people get burned. Under Secure 2.0, a sole proprietor can establish a solo 401k after year-end, up to the tax filing deadline, and make employer contributions. That's real relief, and it's genuinely useful. But the employee deferral election, the part that carries most of the benefit, generally needs to be in place by the end of the plan year. So a plan opened in March for the prior year often gets you the employer piece and not the $24,500. Half a loaf. I'd rather you have the whole loaf. Which brings me to the thing everybody actually types into Google in January: quarterly taxes. And I'll say what I always say. This feels scary, and it isn't. It's arithmetic. The self-employment tax rate is 15.3%, and it applies to 92.35% of your net earnings. The Social Security portion, 12.4% of that, stops at the taxable wage base, which SSA set at $184,500 for 2026. Above that line, only the 2.9% Medicare portion continues. So if you're a freelancer netting $210,000, that wage base matters enormously to your Q4 payment, and almost nobody plans for it. The safe harbor is the part I want you to actually memorize. If you pay in at least 100% of what your total tax was last year, 110% if your adjusted gross income was over $150,000, the IRS won't hit you with an underpayment penalty, no matter how big this year turns out to be. That's it. That's the whole formula. Take last year's total tax line, multiply by 1.0 or 1.1, divide by 4. Pay it on the 15th of April, June, September, and January. You can have your best year ever and still be penalty-proof. And notice how this connects back. Every dollar you defer into that solo 401k lowers your income tax, which lowers your true liability, which means the safe harbor payments you already made might be overshooting. That's a refund, not a windfall. Your quarterly estimates and your retirement plan are the same conversation, and treating them as separate is why people overpay. I help solo workers and gig workers stop overpaying the IRS, and I'd say 7 out of 10 conversations I have start with someone who's been diligent about quarterlies and completely passive about deferrals. Diligent in the wrong direction. The HSA is the other account I want on your radar, and honestly, I think most advisors get this backwards by treating it as a healthcare account. It's a retirement account wearing a lab coat. For 2026, you can put in $4,400 self-only or $8,750 for a family, with $1,000 more once you're 55. Money goes in pre-tax, grows tax-free, comes out tax-free for qualified medical expenses. That's 3 tax advantages in one account. And no 401k or Roth does all 3. There's a wrinkle that's specifically good for freelancers too. HSA contributions you make yourself come off as an above-the-line deduction on your 1040, which means they reduce your adjusted gross income, even if you take the standard deduction. And your AGI is what drives the 110% safe harbor threshold, ACA premium tax credit calculations, and the income phase-outs on the Section 109(9)A qualified business income deduction. One contribution, several downstream effects. The catch is that you have to be enrolled in a qualifying high-deductible health plan, And if you're on a marketplace plan, you need to confirm it's actually HSA eligible. Plenty aren't. And the label on the plan page isn't always obvious. Your family situation matters here more than anywhere else. If you've got a kid with an ongoing condition and you're hitting your deductible every February, a high deductible plan may be genuinely wrong for you, regardless of the tax math. I'm not going to pretend otherwise, but if you're healthy and self-insuring anyway, max it. Pay current medical costs out of pocket, keep the receipts in a folder, and let the HSA balance compound for decades. You can reimburse yourself years later. There's no deadline on that. So what do you actually do between now and the end of the year? Here's what I'd do in order. Open the solo 401k now if you don't have one. Not in November. Now, while the employee deferral for the full plan year is still available to you. Fidelity, Schwab, and Vanguard all offer them without administrative fees for a plan with no employees other than you and a spouse. The paperwork takes under an hour. Then set the deferral election in writing, dated before December 31st. Even if you're not sure you can fund the full $24,500, elect it. You can contribute less. You can't retroactively elect more. Then pull last year's Form 1040, find the total tax line, and multiply it by 1.1 if your AGI cleared $150,000. Divide by 4. That's your quarterly number, and you can stop stressing about it. And then, when the IRS releases the 2027 cost of living notice this fall, all you're doing is updating 2 or 3 figures in a spreadsheet you already built. The structure doesn't change. The numbers move by $500 increments, and you adjust. If your income is genuinely lumpy, 3 great months and 2 dead ones, which describes most freelance years I've had, you can use the annualized income installment method on Form 2210 to match payments to when you actually earned. It's more paperwork. It's worth it if your Q1 is thin and your QOR is enormous. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this saved you a headache, subscribe. I put out one of these a week and they build on each other. And if there's a specific 1099 or retirement account question that's been nagging at you, put it in the comments and I'll pull it into a future episode. A lot of these videos started as somebody's comment. Next week, I'm breaking down how to write off the laptop, the camera, and the desk. Section 179 versus bonus depreciation for 2026, and which one actually leaves you better off. That one's going to be useful.